This morning, private equity, the appetite for risk, seems to be returning. Joining me now is Louis Lehot, a partner with the law firm of Foley and Lardner. Louis, great to see you. Thanks for joining us on the program this morning.
Good morning, Jeffrey. Glad to be here. Thanks for having me.
Yeah, and I can see the beautiful scape outside your window. Looks lovely. Looks like you're having a lovely day where you are. Let's talk about private equity in 2025. Obviously, we just passed Q3, but it appears that there is a sense of optimism returning in private markets, but specifically, private equity.
Yeah, Jeffrey, it's been a tale of two worlds for the last few years, where sellers wanted an 8 to 10x multiple on an exit, and buyers didn't want to pay more than a 6x multiple, and the gap that you would normally bridge with financing or earnout just got really wide, with the greatest increase in interest rates that we've seen at least in my lifetime, that came together with the greatest squeeze on the Fed, on monetary policy that we'd ever seen, and those things happened all together at once. And so you really had a monumental shift in the cost of money, in the cost of holding money, and so private equity really has been in a bind. So we all thought that with the beginning of 2025, a new administration, deregulation, less regulation, hopefully some declines in interest rates, some easing of pressure on M&A, that we would have private equity firms back in the market. And unfortunately, we got hit with uncertainty. Then in the beginning of Q3, we had finally some resolution on what tax policy was going to be. We had the one big beautiful budget act, or bill act, which bridged us for about 3 months until the next crisis. But we saw a really active Q3 in private equity, and I think that was really driven by secondaries, where private equity was able to package assets together, either singly or together, and sell them into other funds. We had GPs that were out able to raise funds for their GP vehicles. We saw some DPI, or return of capital, to investors. DPI is this ever important metric, Jeffrey. I know you know this, of distributed proceeds invested ratio, and we finally had some DPI in Q3 as GPs were able to return capital to LPs, and then at the beginning of Q4, we had the government shutdown. And as I speak to you this morning, Jeffrey, we have great hopes that finally has been resolved, at least through the end of January, and hopefully we're now going to have a strong end of the year. There's just I've never seen a backlog of such great technology companies ready to come out and have a fabulous exit as I do now, whether that's going an exit via the public markets or some sort of an M&A sale.
Yeah, and let me ask you about, all good information, and as you said, it seems like things are trending in an upward trajectory. That's really great news for investors. Let's talk about fundraising. Are you seeing, and obviously you're not a private equity firm, but presumably you represent many GPs, and are they seeing an uptick in fundraising, meaning interest from pension funds and endowments and foundations and other high net worth family offices? Are they seeing an increase in interest in what they're offering?
That's a great question, and I do think that the rise in the public equity markets that we've seen in 2025 year to date has what I'll call right-sized some upside down portfolios. So what we saw in 22, 23, and 24 were that, limited partners, large investors in private equity funds, were overexposed to the asset class because they had the value of their public markets portfolio had not kept up with the value of their private equity portfolio, and so they were overweighted on PE. And now with the real run up in the equity markets, they're right sized, and I think they're back in the market looking for funds. So what I'm seeing is that a first-time fund is able to raise capital relatively easily. A
Mhm.
second or third time fund that has a low DPI metric, Jeffrey, is having a real struggle still. And then, the historical large, what I'll call super funds or multi-stage, multi-sector funds are able to raise capital again right now. And so I think it's going to be a great finish to 25 and a good start to 26, assuming we don't have another government shutdown.
Yeah, fingers crossed on that. Hopefully, Congress and everyone can get their act together, so to speak. That's just my personal opinion, so we can
Yeah.
avoid this in the future because it has so many deleterious effects in so many aspects of the economy, as you've already said. Let's, if I could, I know your one of your offices is located in the heart of Silicon Valley, in San Francisco. Are there specific sectors where you're seeing private equity maybe have a greater interest? As an example, artificial intelligence is one that you can't read it, you can't pick up a newspaper, or at least one virtually, and see that AI is not in some article. So is that a particular sector of interest? Are there other? I've been reading about accounting firms, maybe some big restaurant chains. Are there other areas of interest in terms of investments?
Sure, great question. I think defense tech is an area where private equity is really looking deep. I think there's a consensus in among Democrats and Republicans that our defense systems are going to need to be upgraded. They're going to need substantial investment in the years to come. At the same time as we have some pretty important hot wars going on in multiple geographies around the world. So I believe that defense tech is going to be a big area of growth in 2026. Space is a place where we're going to see a lot of growth as building satellites, which can enable telecommunications, broadcasting, are going to continue to be important, and how they interact with defense systems. So I think defense tech is really a big area where private equity can go, and it's one of those areas where it's too rich for venture capital to go, and it also is an area where you can have, if you sign a government contract, you can have pretty good visibility 5, 10 years out on what revenues are going to look like. So it's very financeable, unlike some speculative new technology that we might cook up here in Silicon Valley, such as AI, where people are not yet comfortable. People in private equity can't really bank on, the next 5 to 10 years of revenues.
Let me also ask you about, you mentioned the one big, beautiful budget act or bill. They keep on changing the names, but I think the president refers to it as the big, beautiful bill. But let's also talk about some regulation or regulatory changes. I think the Department of Labor, there was an executive order to the Department of Labor to establish some protocols and regulations around private markets in retirement plans. I know that may not be a particular area of expertise for you, but you're dealing with these firms. They have to be, bullish on that opportunity. It's a $29 trillion opportunity. Are you seeing a lot of interest in terms of creating products, services, et cetera, for that marketplace?
It's early days, Jeffrey, in that regard. So I think many new funds are in the planning stages to take advantage of that deregulation, but much rulemaking needs to happen yet to allow those projects to come to market and crystallize. But I do think there's a lot of optimism about the private equity industry and their ability to tap into new sources of capital from retail investors.
Yeah, and it's not just private equity. It would be all forms of private markets and
Yeah.
cryptocurrency. So, I think the market, just speaking for myself, not for anyone else, it's always good to look at new products that become available if you're managing a retirement program or you're investing in one. Certainly, one of having access at least is a good place to start. And now that presumably the shutdown will be over, at least temporarily, assuming fingers crossed, toes crossed, legs crossed, hands crossed, eyes crossed, that doesn't happen. But presumably they'll be able to get back to work at the Department of Labor to maybe help put some of those rules in place. Louis, we're going to have to leave it there. I could talk to you for hours. Great analysis, Great work. And look, we look forward to having you back on the program again very soon.
Thank you very much, Jeffrey. You have a great day ahead.
That's all for this morning's episode, but we're back again tomorrow for another great edition. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.